I want to talk about two things today in particular. The first is really about the core of what GrowthX is all about, why we exist, and where our focus areas are. And then secondly, how that's evolved into an ecosystem play where accelerators, incubators, countries, governments, entrepreneur support organizations, entrepreneurs are licensing our model all around the world to help their companies grow and succeed. So we'll start with our approach towards finding product market fit and why we do what we do. The fundamental problem is that we're a group of serial entrepreneurs turned investors, turned frustrated investors because our companies were failing, not because they couldn't build products, but because they couldn't build markets. Yet in Silicon Valley, where I'm based, most people are focused on markets. Excuse me, most people are focused on product. Yet 8 of the top 10 reasons why these fail have to do with markets and behaviors, not products and technology. So we wanted to be focused on that. So over time, we've built a very successful seed stage venture capital fund with an accelerator program that was focused on developing markets and making money, not developing products and raising money, although that's important. There's a genuine imbalance in the community, in our view. And we'd like to bring that back into balance. We also have our corporate innovation group that works with large corporations on venture capital, open innovation, commercial innovations, building ideas and turning those into marketable products. We have our accelerator program, and we have our academy, which trains the people to work in the startup and scale-up community in non-tech roles. Think of it like a coding boot camp, but for all the coding related, such as sales, digital marketing, growth marketing, UX design thinking, data science. And that's a way to transition awesome people from existing industries into working in the community. So we live in what we call this age of applied technology, where it's never been easier or cheaper to get a product to market. And partly as a result, it's also never been more difficult and expensive to get traction for that product in the market. And as a result, the funding requirements have shifted down to the seed stage. What used to be a requirement at the A round was to get early customers, early revenue, and show a path to product market fit is now a requirement at the seed stage. And outside of friends and family, or if you've been an entrepreneur who's won before, or entrepreneurial support organizations like yours, and governments, it's really difficult to raise capital early. So you've got to show early customers, early revenue, and a path to product market fit. And as a result, in venture, the same amount of money is being deployed just across more companies in smaller tranches, because in the age of applied technology, most of what we're building can be fairly capitally efficient. So the emphasis needs to be more so today than ever on market development, not just product development. And as a result, we built an accelerator program to solve our own problem first. And the idea was, once again, how do we help our companies find product market fit? So we have a seed stage fund that invests in a company, and then once the company is actually in the portfolio, it can then apply one-off fashion to work alongside our market development team to go through our milestone-driven, traction-based approach towards finding product market fit, where we earn additional equity. It's not awarded or bought like in the Y Combinator environment or a 500 environment. We'll write a check for $100,000 as a part of $1 million seed round, for example. We'll get our 2% of the company on a $5 million cap on a note as an example. So we'll buy that. But the entrepreneurs who care more about our health than our money will award us additional equity based on the work we do together to help them find product market fit. And I'll walk you through exactly what that technology and approach is like, and how you may be able to apply something similar in your environment. We've now, as I mentioned, for the last 5 years have done this successfully for ourselves. 70% of funded companies in the Valley fail to ever get to another round of funding or to break even. 80% of the reasons have to do with markets and behaviors, but our failure rate's in the low teens. And it's because we think that our focus on product market fit and market development over product development is the reason why. And now we started to license it around the world to various organizations, including Atlantic Canada. Propel ICT is our newest partner. And we're working with several other Canadian partners right now. We just announced an MOU with Spark Center in the Eastern Ontario corridor as well. So the purpose of our framework is really important for everybody to understand. There's three real things that we're trying to get at. The first thing we want to do is find the truth about where your product fits in the market, if it does at all, and what to do about it. We want to create a functional learning organization out of the team that's responsible for pursuing that truth to make it as capitally efficient as possible. Again, understanding the basic premise is that we all have limited time and money to find out where our product fits in the market. And then the third is to demonstrate that profitability could exist at scale based on the unit economics of what we're learning. People always ask the next question, which is, well, is this a B2C framework, a B2B framework? Does it apply to marketplaces or B2B2C? It applies to all because it's about the stage of the product going someplace new, which is a learning experience. So what I call H to H, human to human. Most required to learn at this stage and find product market fit is unstructured, and it comes through analog offline interactions with a marketplace. So how do you take that data and create these functional learning loops so that you can quickly iterate? So as I like to say, products and markets may be unique, but the path to product market fit is not. At some point, we all have to do the same things. So our framework is designed in a sequential fashion to ask the right questions at the appropriate time to seek patterns that would imply that there's predictable, scalable, repeatable growth across these different areas. So I'll go into the milestones. There are three. There's four for corporations in commercializing innovation, but within startups and scale-ups, there are three. Milestone one is market foundation and discovery, where we cover really what resources you have to execute, how do you set a market milestone, and who's your best customer right now. And there's a very important thing to notice about as we go through these in a little bit of detail, our structured approach towards this. We start again with a milestone, then we have a phase for that milestone, which you can see as resource review. The next thing is a goal. What are we actually trying to accomplish? Then how do we accomplish it? What are the things we need to do in order to create the outcome at the bottom, those areas? And then ultimately we have a measurable, definable, deliverable at the end. So in resource review, for example, the goal is we want to create a roadmap of the people, processes, and technologies necessary to create and support that functional learning effort that I mentioned earlier. And in order to do that, the first thing we do is a resource review of mapping and planning. Resources you have today, what's related to product, what's related to market, how are they allocated? And we're talking about people, we're talking about expertise and knowledge, and we're talking about capital. And any tools, et cetera. And then what other resources will you need down the road once certain events happen? In other words, what happens when you actually achieve a market milestone and you get 3 customers? How are you going to onboard, implement, support, and grow them? Do you have the resources to do that now? What happens when you start getting feedback about product and you have to ramp up development? What do those things look like? Because this is all going to inform our initial market milestone, which is a quantifiable goal that we set as an org. That says that over this period of time, we're going to get this many customers or this many pilots or this many interviews completed. And we have to make sure that we have the resources to do that. And we need to make sure that we're allocating those resources appropriately. Because once again, behaviors are one of the primary reasons companies fail. Spending time with the wrong people at the wrong time takes away opportunity and resources. Once we do that, we want to understand how you currently are acquiring customers, if at all, or attracting them. And that starts to inform the story about what your customer acquisition strategy and model is going to look like over time. We want to understand how you're tracking that, if you are at all. Most of us aren't, that's fine, but at some point you have to begin tracking all the outbound and inbound activities so you can learn effectively. So that's resource review. Then we move into the heavy lifting of what we call market discovery. This is all about how do you create an initial customer profile. Not an ideal one for the long term, because when we start a company, we have a vision of what our customers might look like based on whole and complete product. And the reality is that nothing that we're doing is whole and complete yet. There's also a certain psychology of the kinds of people that are going to invest the time and truth necessary to help you learn at this stage. They understand your vision, but they also appreciate your reality, and they're willing to go on that journey with you, which is why we talk about how we recruit early customers to work with us as opposed to sell products to people. So the goal here is to understand the current customer life cycle and prioritize our resources so that we actually go after an initial customer profile that matters. We want to understand the unit economics so we can start learning about the profitability opportunities that might exist. And then we want to figure out what channels and approaches and methods and means by which we're going to actually go out and talk to the market and get people to talk back to us. This is where we get deep into a current account map and pipeline review. Who's your oldest customer and how'd they find you and who are they and what's their profile? What's their psychology? Why are they doing business with you? And we work our way all the way through the oldest to the newest, and then from the bottom of your current opportunity pipeline to the top of your prospect funnel so that we get a picture of all the different customer profiles that might exist, the use cases associated with that, and how that's going to inform where we're going to prioritize, because we need to get down to just one, if at all possible, super narrow profile that allows us to get the most learning done with the least amount of effort, time, and resources required so that we can build something that creates momentum. And that profile at the initial stage is very different than that long-term one. Then we want to look at the current pipeline and prioritize everything around that. Once we've established what we're going to test as our initial customer profile. Again, you might have 7 or 8 or 9 or 10, or you might only have 1, you might have 2. But we want to select one that gets us to where we want to go the fastest and focus on that one. And then we prioritize the pipeline around that. And then we want to look at your current customer experience. We ask the question, how easy do we make it for people to do business with us? Something that we don't think much about. But there's several asks that we have. What are we asking our customers to do? What do they think about that? And how do they feel about it? And what can we do to optimize that experience? Because our customers, especially at the early stage, they don't want more work, they want less. How do we create an environment where we provide less work, not more? Then we want to look at how we're charging and pricing a product and service. And in other words, again, pricing is difficult. Business models are a challenge. But there's really just 2 areas that matter. There's headcount-based revenue and non-headcount-based revenue. And how do you put those together in a way that solves a problem and creates value? And then we want to talk about your customer acquisition strategy. How are we going to actually go out to the market and get these people to work with us? And then our data acquisition strategy. Where do we build a list of these folks? Do we build our own? Do we buy one? Do we rent? Do we buy? How does that work? So by the end of milestone 1, market foundation, we want to prioritize roadmap of the current customer life cycles. How are we going to allocate resources to it? How long does it take to get a customer? What does that look like? We want a really deep understanding of what our initial customer profile looks like and how we're going to go find them, and then how we might be charging for that. Okay? These are sort of the questions that you want to have answers to, or at least and have a really good initial hypothesis around. What resources you need to test and execute on your idea, who's a good ideal early customer for you, how to prioritize for learning and eventually for growth, because that learning is going to lead to the revenue that you're looking for, where to find these folks, how to talk about pricing and prepare yourself for a pricing model that gets somewhere towards a unit economic that makes sense, and how we're going to go find customers and what channels we're going to use to find them. Are we doing this over the phone? Are we doing it in person? Are we using Facebook or Instagram or Google or some network-based combination of those things, say LinkedIn? Are we doing cold calling, et cetera? And then what market milestone are we going to have? 3 customers in 6 months that are piloting the product and clearly defining what that looks like as one example. Something that we can all get behind and that we know we can achieve based on the resources that we have today. And then what data acquisition strategies are we going to employ to make sure we know how to find these folks? So now, by the end of this, we should know who our early customers and how to find them. Now, the next thing is milestone 2, which is all about what we call market messaging and outreach. It's about how do we talk to the market in a way that doesn't necessarily sell, but it seeks fit and it gets people to try and tell us the truth. Because we live in a world today where people won't tell us the truth if it creates more work or conflict. So our approach towards learning and our effort at this point needs to be that one of humble curiosity and deep focus. Here I made this, I think I can help you. And here's why. I'd love to know if that's the fit right now, not forever, but right now. Then we want to instrument technology that just allows us quickly to easily track all of our activity inbound and outbound. And then we actually begin initial market outreach. So the goal here is to develop an initial messaging hypothesis that's designed to track those early customers and tell us the truth, and then build what we call a market message map that says, for this message through this channel and this method and means, with this customer profile and use case, this is what we say. And we do that for every channel that we select and every method and means that we select to take to market. And it becomes a really good template for us to work off of over time. So how do we do that? First is we want to talk to existing customers and or prospects. We don't want you to do it. We want a third party to do it. We want a UX designer or someone else who's skilled in constructing the right kinds of questions that isn't biased, like a traditional founder might be, to collect the lexicon, taxonomy, and the words that these people use to describe a problem. Because nobody cares about our products. They care about their problems and whether or not you can solve for them. And so we want to get into that mindset. And then we use that data to build our initial framework of value props, selling props, things that have to be unique. One of the major reasons these companies fail is lack of differentiation in the marketplace. And if we can't find differentiation, then there's probably not unique value there. It doesn't mean you can't be successful. It just changes. It should change your expectation, because you should be seeking things that are unique. So a selling prop tells me what you do and how you do it. A value prop, which is more important, tells me what you do for me. And we need to lead with value props. We tend to follow with value props. 80% of the founders we see bury the value proposition under all their product stuff. And as I said, no one cares about our product stuff until they understand what the value is. So we got to lead with that value. Then we build an initial attraction framework that says we're going to go out and try and get people to talk back to us. And then we build a conversational framework that says, okay, now that somebody says, ooh, that's interesting, tell me more. How do I run a conversation that gets to the truth about whether or not we should be working together right now and we're a good fit for one another? Nobody teaches that. It's very frustrating, but it's one of the key areas where companies get stuck. So the outcomes out of this are, we want an initial messaging hypothesis for the ICPs that we're going after. We want that message map fully aligned to our customer acquisition strategy. And then we want to be able to implement the tools necessary to support functional learning and track all this stuff. And that's market messaging and outreach. And then the goal of initial outreach is to build an early portfolio of the things we need to be able to tell our story to the market and allow our customers to socialize that stuff internally. So basic websites, basic PowerPoints, basic promos, but be very simple. And then allow, once you've built a funnel and start having active conversations, allow the customers to tell us what we need, whether it's case studies or stories or whatever those things are. And then we want to create a closed feedback loop for tracking the messaging and iterating on it rapidly. So when we do initial outreach, we may have a top of a funnel with 500 customers, but do one blast to 500 people. We're going to do a blast to 25, and we're going to learn from that. And then we're going to do another one to another 25, and we're going to learn from that. And we're going to do this in a very small and focused and iterative way. And there's somebody that has to own the market who's responsible for rapidly iterating on that. Then we set up our campaigns and we start executing, and then we build an opportunity framework where we do the stages of our funnel and how we're going to take people through it. And most importantly, how we're going to disqualify people out. We shouldn't have a mindset of trying to get everybody to do business with us. We should have a mindset of trying to get the 3 that we need over the next 6 months that are the best fit, not demographically or geographically or use case based, but psychologically. Who's willing to invest the time and truth to help us learn? And so we walk out of this with a portfolio of things we need and a closed feedback loop. Then we're ready to actually go to market. And so at the end of milestone 2, these are the questions you should be able to answer, at least have initial hypotheses around. And it's important to note that, and we'll talk about this in milestone 3 in a moment, constantly updating on every aspect of the milestone-driven approach based on what you learn until you find repeatable, replicable patterns. So you'll always be coming back to these things. So this is where you figure out how to talk in a way that generates the feedback you want, how to attract and qualify those people, what your unique value hypothesis should be to the marketplace, or at least to that customer profile, or what set of those are, and then how you're going to explain how you're unique and different. How you're going to hopefully know how to learn from customers to further develop that messaging, build that message map and the portfolio of assets that you need, and create that closed feedback loop. Now, we've begun what I call truth seeking from the market. We need to effectively manage functional learning, which is what milestone 3 is all about. Market results. So how do we now manage the response and the feedback from the market so that we're building something people want? The more we do this, the more time we tend to spend with fewer customers going deeper, with the idea that if I can solve it well for this person or these 3 people or this company, then I know there are many others out there just like them. And you can do this in a very service-oriented way as well. You don't have to have your product whole and complete. People just want their problem solved. Sometimes it doesn't mean tech. It means expertise and insights, and that's okay. I wrote an article called The SaaS Learning Curve. Why SaaS should be called Service as a Software, not Software as a Service, because our learning has been our most successful applied technology investments have been in companies that started out as heavy service providers first, or stayed in the service mindset while they were building a product to ensure it was successful. So the goal, milestone 3, is to measure and track the market response so that you optimize your customer profile, messaging, outreach, conversion rates. You want to validate and document all the hypotheses that you can as they come, and then you want to get prepared for what scale might look like. And so our first focus area is to get really deep into opportunity and pipeline management, defining what opportunities look like, qualifying as many people out, and driving a behavior that gets us to that market milestone. We want to develop an onboarding and implementation framework. What happens when a customer says yes? What do we do? Do we have that planned and mapped out? Are we a duck on water, or are we flailing around and letting everybody see that? And then how does that inform the resources we're going to need as we start acquiring customers? Then we want to build a nurture and opportunity framework. What we do with anybody who could be a good customer later but isn't a good customer now that we've engaged. We set up a framework so that we can automatically nurture those folks over time, sharing our progress and our wins, keeping us top of mind through content, thought leadership, and whatever else we need to do so that later they're warm when the timing is more right for them. And then we want to implement the most important, what I call a product market feedback loop. You have one person responsible for collecting all the market data, and you have a person that's responsible for building the product. Ultimately, those two are held accountable to each other, and they've got to work together. Are they meeting every Friday afternoon at 3 p.m. for an hour, reviewing the product roadmap and then reviewing the market roadmap? And the market roadmap says, these are the top 3 things our current prospects and customers are asking for that we don't have. Mr. Head of Product or Mrs. Head of Product, why aren't we focused on building these things? And you advocate. And hopefully you've got a product head or a product founder that respects what the market wants and isn't just building to a vision. If you don't, it's not going to be a great experience, and it doesn't necessarily mean you win, but you probably won't enjoy it. Okay, so then the outcomes of milestone 3 are, you want to have all the stuff optimized, messaging, outreach, conversion message, customer profiles, a decent go-to-market and scale strategy attached to that. You want to validate and document all your hypotheses through the market development lifecycle. You want to have a good recruitment marketing plan. In today's market, there's no difference between your corporate or product brand and your employment brand. What kind of company do you want to be when you grow up? This is what people care about. What does your brand say about you? How do you attract A+, so that you have a strong core team that you can grow around? And then we want to make sure that this is all documented in what we call a market acceleration playbook that gives you the manual for growth and scale. And by this point, you should have sound justification for why you want to go raise more money at all. So here's what we know at the end of 3. You know how to successfully run a functional learning plan. You know how to market, measure and manage market response at scale. You know how to validate most of the steps across all 3 milestones. You know what messaging works for each customer profile across format and channel and mean and method. your conversion rates are going to be for those customers, hopefully. So you can start thinking about your scale outbound and what your cost to acquire customers versus lifetime value. You should have a sound employment brand in place, and how to continue to attract the right kinds of people into your orbit, and then how to support repeatable, predictable, and scalable growth. And this should give you the evidence you need to go raise more money. And when people ask me what I mean by product market fit, how do I define it? To me, it's pretty simple. When you don't have the resources to keep up with the demand that you've created, that's when you know. The next question I get from everybody is, how long does this take? The question or the answer is, I don't know. It's different for everyone because I don't know what I don't know about your market. I don't know how I'm going to respond. I don't know what the acquisition life cycles are. I don't have answers to these questions. Companies in our portfolio can work through these milestones roughly in 6 months sometimes, and as long as 2.5 to 3 years. It just depends on what they're doing. The fortunate thing of the funding structure and model is that we have an agreement with our LPs that we can invest LP capital, not just in writing a check for a company, but in a team of market developers that I've personally recruited and trained in this methodology to work alongside our portfolio companies, provided that for every dollar we invest in that team in the form of labor and salaries, we're getting at least $2 in equity in return based on the current valuation. So that allows us the flexibility to work with a company, potentially, for as long as we want, is provided that we're getting that essentially 50% discount on the equity, because we're getting 2% for milestone 1, we're getting 2% for milestone 2, and we're getting 1% for milestone 3. And based on the valuation, the math for us to track and manage and know that our LPs are getting a de-risk deal with more insights on follow-on investment opportunities based on what we the company by working alongside them. They're getting equity for that. The entrepreneurs are getting the help they care about without having to put cash out, and everybody wins. And so that's how we hacked venture, because we just didn't like the way things were done in Sand Hill. It didn't. The 20 model that's traditional VC does not allow a seed stage investor much capital to help a company. If I invest $100,000 in a company, I'm paid $2,000 a year as a general partner to care about that company. So you see much larger rounds in later stages and a lot of help from senior people with fat salaries. And what I think is a misalignment of capital. They're getting too much money because that's how these companies, these funds sort of operate. Your valuations are often predetermined the first time you take institutional capital, and you've got to fall within those parameters. That's a whole other discussion, but that's how our fund structure works and how others are using it to provide meaningful help and a fair exchange of value at the seed stage. Now, normally that's sort of the end of the whole kind of product market overview talk. But given the fact that you're all regional innovation centers, and I've met and talked with some of you in the past, look forward to doing more of that. The other question people are always started to ask us was, well, can you bring this to where we are? How can we take advantage of this? And so I started to look broadly, and we did, at general ecosystems around the world and what makes them successful and what's missing. And as we evolved and started our own problems, the first was, how do we help at the seeds? So we created a new model. It was, how do we reduce the failure rate? So we created a market acceleration program to do that. The third was, how do we create a business model that allows us to provide help at scale and not be stuck on the assets under management problem that exists in funds? And that's why we created GrowthX Academy and built a mentor network around that. And then it was corporations and scale-ups and started to approach us and say, hey, how do we do this here? So I just want to share my thoughts quickly on what's missing from innovation ecosystems at large. And I put this talk together for NACO Summit last year. And it's been fairly popular since. But there's really kind of those things that are missing. How do we efficiently invest capital that helps founders succeed? How do we create alignment with all parties, funders, founders, those who want to work for them, those who want to buy from them, and those who want to support them? There's total misalignment in today's marketplace around that. How do we accelerate market development, not just product development? How do we develop the talent in a marketplace to succeed in this? I've sat on several of the accelerator, the monthly global accelerator calls across Canada that have as many as 114, 115 different accelerators on there. And the two things that come up every time is that there's a skills gap. And then there's also this struggle to have a business model that doesn't just involve real estate and raising money from the government. What if you actually had a business model? You could go back to the government and say, look, yes, fund me for the next 3 years, but after that, I'm going to be self-sustainable. And let's now start talking about how we take this capital and use it in more meaningful ways. You can do that when you've got a school that's charging tuition to the community, learn new skills, and work in your startup community. You can do that when you're providing corporate innovation services to the corporations that are struggling to figure out what to do next and not how to be the next yellow cab in the age of Uber. And I hear that over and over again from accelerators and incubators. They come to us, but we don't know what to offer them other than events or a space where they can put their logo. So how do you meaningfully engage with those folks? So those are the things that have been missing. It's ultimately an aligned incentive structure, business model, and a way to effectively help everybody in the ecosystem grow measurably. So that's number one. I call it kind of missing the how. How do you efficiently invest capital that helps founders succeed? How do you accelerate market development, not just product? How do you develop the talent in the ecosystem to succeed in the innovation economy where you can't prepare for a future that you can't predict? So how do you create enabled, accelerated learners that can go from oil and gas right into working in a tech company in a market development cycle of UX design thinking or data science or entrepreneurial selling or digital marketing or even the necessary engineering and coding programs that could move into that space. And then how do you meaningfully include all the big customers in the ecosystem so that our best talent doesn't leave Alberta and go to the Valley because it feels like it has to, because that's where it is. And so, I spend a lion's share of my time now trying to bring this kind of thinking and this ecosystem approach to different markets to help them build a lasting and sustainable ecosystem. And it involves doing those things. So, Michael is coordinated in this way. Help is our due diligence to de-risk deals, generate larger returns for our LPs. They love it. The founders and funders love it, the acceleration program, because once again, they get more help. They care, the ones that we invest in anyway, and try to attract into our community are the ones that care more about our help than our money. We work with scale-ups that are already funded, that want the same kind of methodology. They want to leverage the students in the academy who can work in their companies and get a real portfolio of experience while they're learning. And those startups get help, and we get due diligence from that. So we know what deals are good and which ones aren't. We know how to help corporations stop murdering startups. Bless them all, but they think very differently, and most big companies are run by operators, not innovators. And so how do you get them engaged in whether it's through investing or acquiring or launching new products and services, using the same mindset, and then reskilling and upskilling their workforce to be prepared for this economy so they don't lose their top people. And then how do you upskill that and reskill that talent pool and attract the right kinds of folks, and then unlock the talent that already exists in a marketplace that's looking for that next thing to do to contribute to the tech ecosystem. So that's it for me. I'll open it up for questions now. Looks like we've got about 20 minutes left. You're probably on mute on that side.
That's exactly what I was doing, unmuting you. So I have an idea.
There's many people there that wanted me to be on mute this entire time, so that's okay.
So I have an idea, and we'll see if it works.
Okay.
So I'll get people to talk on the mic, and we'll see if you'll be able to hear it. So just let's play with it.
Great.
John, it's Craig here. Can you hear me?
I can hear you, yes.
So this question came about 5 minutes in your presentation. I'm sure half the people who have the exact same question. How do I get a copy of your slides?
I'll send them over to Craig, and you can distribute them. And I believe this thing is being recorded anyway by Craig, right? So I assume maybe you'll be willing to share that out with everyone as well.
Hey, Sean, it's Terry Rackowski speaking.
Hi, Terry.
How you doing?
Great.
You are speaking my language. Traction speaks louder than words. And I guess more of a comment than anything else is that it's a groundswell to help people understand that if you want to get into a marketplace, you have to understand your client and then have a process of how you're going to get to sales. And for me, it's one of the biggest faults that I see, because we do investments as well on commercial associates. And they'll all say, we're going to email, we're going to be a thought leader. And they have this list of things that they're going to do, and they don't have a process of how they're actually going to do that. So if you have any, besides the walkthrough that you've given us, you have a horror story and a great story. That would be helpful.
A horror story and a success story of companies that we've worked with?
Yeah.
Yeah, sure. So two things. Glad you brought that up. And for those that care to do so, I miss, and my partners would be upset if I didn't share this. If you go to growthx.com, you can sign up for the MXP series. So all the content and tools associated with our market acceleration program are available there and being released one a week for 50 weeks this year. And I think we're about 20 weeks in, 22. But you can go, it becomes a library and a resource. And the hashtag you can follow is GXMXP, which stands for Growth Market Acceleration Program. So that's out there. So I encourage everybody to go, start reading that, absorbing it, sharing the content with their communities. Hopefully it gets everybody in that same sort of market development mindset that Terry just alluded to. Goodness. Okay, so horror stories and success stories. I'll say a couple of things. 50% of funded success startups pivot at least once. A third pivot at least twice is what the data is showing us. So having the right kind of mindset to really appreciate and respect the truth and a problem in a valuable way very well should be the ultimate objective. If you have that ability and you truly have a growth mindset where you don't think about rejection, you think about feedback, and you feedback as a gift, and you behave in that manner in the marketplace, you can get there faster. So I would say that where we've had the most, all of our horror stories sort of always come back to the behaviors of the founders or their value system, and whether or not they are willing to accept the truth about where their product fits in the market, are again able to create that functional learning as part of it. Can they get along together very well? We do it's that whole couples counseling thing when you have co-founders. In our own fund, again, we have our own funds with our own specific fund theses, but we try to avoid solo founders unless they've been successful as a solo founder in the past. And that's for two reasons. There's no balance between product and market when you've got one founder, oftentimes. Sometimes they tend to be very difficult to work with. And so our whole fund structure, and our accelerator structure is that we can quit working together at any time if we don't want to work together or we don't feel like we need to anymore. And we can just walk right away, mid-milestone, whether or not we want to, we've earned any of the equity with the work that we've done and just go back to being a passive, helpful investor. And that's okay. So most of our horror stories are associated with human behavior, but I think that's sort of a life lesson, isn't it? Success stories, I mean, there's a lot of them, right? I can tell a story of one company that almost didn't make it we quit working together halfway through the program because they had one of the three co-founders was cognitively dissident about us, didn't believe in the value of and was constantly trying to sabotage the whole program. So we backed away and then realized very quickly everything that we told them that would come true was coming true. And they, summarily removed that third founder, came back to the program, and they went from a near-death experience to they're one of our unicorns now. And I couldn't be prouder of that moment. And so I hope that answers your question without, naming anyone in particular. To be careful.
Yeah, I don't think you meant for Alexander Brown. I just had a question about the fund structure. So I kind of was following along. Generally, you'll come in and invest an initial amount, and then we'll provide money kind of services in exchange for equity afterwards. It's follow-on investment. Was I understanding that correctly?
Yeah, this is our structure. It's very unique to us because this is the way we've chosen to do it. And those that license from us and choose to adopt this model do, and those that don't. With us, we write a check first. And then once you're in the portfolio, then you can apply for acceleration. And then the team has to want to work with you, and then we need to have the resource, they need to be available to work with you. Because we only write 15 checks a year, and we accelerate somewhere between 6 to 10 of those companies, depending on capacity and fit. And it's well for our model. It's a highly scalable thing too. It's infinitely scalable, frankly. That's the beauty of it. But that depends on assets under management. Now, others are using it just flat out as their structure for their program, or they're adding it to their current and fundraising programming. But I would say that the number one thing, again, I can use the term programming, but that's one of the big areas where people gap that exists is the product market fit programming. Most of our funders, most of our founders, most of our entrepreneurs are really focused on their product and raising money. And then they get that money and they go, okay, crap, what do I do now? At least that's what's going off in their head. And that's the problem that we kind of set out to address as entrepreneurs ourselves. But that's how ours works. It doesn't mean you can't leverage it in any way you want. People are using it for cohorts. People are using it for bespoke. We go bespoke because that's our fund structure and that's how big our team is. That's where we are. I hope that answers your question.
Yes.
Hi, it's David Chavez. Can you just speak about the corporate scouting? I didn't quite catch that part.
The corporate side?
Particularly the scouting.
Yeah, so startup scouting always starts with, you have to have sort of corporates need to have a thesis as well. Just like we have a fund thesis, they need to have a fund thesis or thesis. These are the kinds, this is what we're doing, and these are the kinds of companies that we want to identify, and we run the MXP program right through it. So our ICP process in milestone 1, identifying an initial customer profile, we're doing that for initial startup profiles. So we're going through that exercise with with the corporate, and then depending on how they want to structure their offering, of course we obviously have our recommendations of best practices there. If you have MXP as part of an industry-led accelerator program, you already are differentiating yourself. Because the best founders, at least in the Valley, the reality is that they're funded by VCs. The ones that land in corporates are the ones we've kind of thrown back into the water, to be honest with you. So, and a lot of corporates have gotten a poor reputation or tarnished reputation for how they work with as well. So coming up with a structured thesis about how you're going to attract those companies, what you're going to offer them, that's going to be unique and different, and then how to invest in them under market terms, not non-stuff, so that you don't harm the company in the process. Work with them is really, really important to the CVC strategy as well as to the scouting component. We don't do innovation theater, not in the business of hand waving and events sort of stuff. I guess that works for some folks. We just haven't found a whole lot of substance in it. So we're really focused on a very targeted approach towards finding the right companies for the right reasons, and then determining whether or not those are companies you want to invest in, those are companies you want to buy from, or you want to integrate, whether it's for innovation purposes or external. But running them through MXP gives them what they need, which is, it's in everyone's best interest to make sure that that startup is successful, whether or not you end up doing business together. And that's the reality of dealing with a startup that's got 6 months of runway, and they're working with a corporation that has an 18-month decision cycle. And we see that a lot. I hope that answers your question, David.
It did. I think that's all the questions, Sean. Thank you so much for chatting with us. You can see a lot of head nodding while you were talking, and we really appreciate it. So.